everyone, and welcome to another roller coaster ride as we get through COVID. Cathy Sabater, mortgage planner and proud veteran. What's happening? The Fed makes a promise to keep rates low. So let's have a conversation. Hold on by myself. Let's have a conversation because the Fed fund rate, they're going to keep to zero until at least 2023. Remember, the Fed fund rate is what the banks are charged to lend money. Then the mortgage interest rate is what they use to charge us, right? Because the government is making sure that these banks stay liquid, right? Because the more money, cash flow that banks have, then it helps keep the interest rate low. But let's talk about what happened in 2009 and 2016. Basically, what happened, even though the Fed fund rate was zero, mortgage interest rates still went up for a short period of time based on the market. Okay, so yes, they're going to keep rates as low as possible, but also understand that the Fed fund rate is what the banks are charged, right? So they're not going to have any interest that they have to pay to lend us money. But based on market conditions, like it happened in 2009 and 2016, rates still fluctuated upwards. Okay, so the other thing that the Fed is talking about is that they predict unemployment to go down to 5%, and our GDP, gross domestic product, is going to be at 4.2% for the year of 2021. So what does that mean? Well, if we can get the jobs back, get people back to work, right? Keep that economy going, and then the GDP has to talk about how much money are we earning, right, versus how much money we are spending, okay? Because as we all know, with this pandemic, with the CARES Act and the Stimulus Act, we have all this extra debt that we have, and they're going to manage it accordingly. Housing starts are still high, and believe it or not, it's the highest since 13 and a half years. So we have such an outstanding demand. They still can't keep up, but it's still a record high. And so in regards to the mortgage bonds, they're breaking above their 200-day moving average. So here we go, right? We went down to the downside. So here we are at this moving average. So the next break is 103.953. So as you can see, right, we have a trend to go down, but we also have the opportunity for this to go up. Remember, the higher this number is, the lower interest rates are, right? You would think it'd be easy, but it isn't. But it is what it is. You stay safe. Feel free to call. Otherwise, I will see you tomorrow.